Welcome to the first edition of International Tax Treaties. Today I'll discuss three recent treaties which contain some interesting provisions: Ireland, Kenya, Serbia, Singapore, and Indonesia, Singapore. I'll start with Ireland, Kenya. Article 5.3 in the Ireland-Kenya Treaty is the provision dealing with the PE definition in regard to a building site or construction or installation project. Strangely, in the first sentence, it sets a time threshold of 183 days, which is equivalent to the time threshold that generally applies to the fixed place of business PE in Article 5.1. However, unlike Article 5.1, it goes on to provide for the counting of additional time if connected activities are carried on at the same building site or construction or installation project during different periods of time, each exceeding 30 days, by one or more enterprises closely related to the taxpayer. This anti-contract splitting rule is not in either of the OECD or UN model treaties, but it is included as possible text in the OECD and UN commentaries on Article 5.3. Also, the rule is included in Article 14 of the MLI. See the words "for the sole purpose" at the start of the second sentence? Let me make a few comments about those words. Those words, "for the sole purpose," mean that the rule is relevant only for the determination of PE status of the taxpayer. If a PE exists, the connected activities would generally not be taken into account in determining the taxpayer's profit, which is attributable to the PE under Article 7. Unless the closely related enterprises perform the connected activities not as separate contractors but as subcontractors to the taxpayer. Also, it's possible that Article 5.3 could be separately applied to each of the closely related enterprises as taxpayers if they are resident in the same contracting state as the taxpayer. Article 8 provides different rules for aircraft and shipping operations in international traffic. Article 8.1 contains the usual rule for exclusive taxation in the residence country, but this is limited to profits from aircraft operations. In contrast, Article 8.2 permits the source country to tax the profits from the operation of ships in international traffic, but it places a cap on that taxation equal to 50% of the tax otherwise imposed in the source country. Article 8.3 includes in the profits of aircraft operated in international traffic profits from the rental of aircraft if certain conditions are satisfied. There's no equivalent provision in regard to the profits of ships operated in international traffic. That then raises the issue of whether profits from the leasing of ships would fall within the general description, profits from the operation of ships in international traffic, in Article 8.2, which would allow source country tax of those profits subject to the 50% cap, or alternatively, whether the gross income from the leasing of ships would be covered by Article 12, the royalties article, which would allow source country tax of 10% on the gross amount. The definition of royalties includes payments for the use of or the right to use industrial, commercial, or scientific equipment. Article 11.4 includes a definition of interest which is very similar to the corresponding definitions in the OECD and UN model treaties, but it adds the words I've highlighted, but does not include any income which is treated as a dividend under Article 10. Article 23 sets out three special rules applicable to offshore activities. In other words, activities in connection with the exploration or exploitation of the seabed and subsoil and their natural resources. The three special rules in Article 23 concern a deemed PE if those activities are carried on in a contracting state for a period or periods exceeding 30 days within any period of 12 months. And in applying that test, you aggregate time spent by an associated enterprise carrying on substantially similar activities in the same state. Taxation of salary, wages and similar remuneration, and capital gains. And the final provision I've selected from the Ireland-Kenya Treaty is Article 25.6, which is in the non-discrimination article. Article 25.6 states that the non-discrimination article shall apply to taxes covered under this agreement. Presumably, this means shall apply only to taxes covered under this agreement. It's therefore different from the corresponding provision, Article 24.6, in the OECD and UN model treaties. The provisions of this article shall, notwithstanding the provisions of Article 2, apply to taxes of every kind and description. And now the Serbia-Singapore Treaty. Article 3.2 says that for the purposes of Articles 10, 11 and 12, a trustee liable to tax as a resident in a contracting state in respect of dividends, interest or royalties shall be deemed to be the beneficial owner of those dividends, interest or royalties. As you know, there's no similar provision in the OECD and UN model treaties, and it's an unusual provision in bilateral treaties. By the way, the treaty contains the usual rule in regard to undefined terms, but it's Article 3.3 in this treaty. Article 5.4 provides a furnishing of services PE definition, which corresponds to Article 5.3b in the 2011 UN Model Treaty, except for the fact that the time threshold is 270 days in any 12-month period. That's a long time if you count, as I believe you should, only the days on which services are furnished. In other words, if you don't count days on which all the employees or other personnel are on leave, such as weekends and public holidays. If you exclude all weekends and public holidays, the time threshold, 270 days in any 12-month period, effectively means all work days in any 12-month period. Article 8.3 provides us with another variation on the definition of profits from the operation of ships or aircraft in international traffic. It includes in the profits from such operations profits from the rental on a bareboat basis of ships or aircraft, profits from the use, maintenance or rental of containers, and interest on funds directly connected with such operations, in all cases if certain conditions are satisfied. You will see that in regard to interest in Clause 3, there's a statement that the provisions of Article 11 shall not apply in relation to such interest. So that resolves any conflict issues in favour of Article 8. However, having thought of the conflict issue in regard to interest, it's strange that the treaty writers did not put a similar statement in clauses 1 and 2 in regard to royalties. Article 12 defines royalties to include payments for the use of or the right to use industrial, commercial or scientific equipment, and it allows a 10% source country tax on gross royalties. Article 23 is the non-discrimination article. Article 23.5 excludes from the article tax incentives granted by a contracting state to its nationals to promote economic or social development. As you know, there's no similar provision in the OECD or UN models. And just as we saw with the Ireland-Kenya Treaty, Article 23.6 of the Serbia-Singapore Treaty limits the application of the non-discrimination article to the covered taxes in Article 2, provided you interpret Article 23.6 to mean shall apply only to the taxes referred to in Article 2, which I think is the correct interpretation. And the final provision I've selected from the Serbia-Singapore Treaty is a most favoured nation provision in paragraph 1 of the protocol which accompanies the treaty. The MFN provision relates to the inclusion in the definition of royalties in Article 12 of payments for the use of or the right to use industrial, commercial or scientific equipment. If, after the entry into force of this treaty, Serbia signs a treaty or protocol with a third state in which the royalties definition does not include such payments, then the MFN provision is triggered. But if it's triggered, only two actions are required to happen. Firstly, Serbia will notify Singapore in a timely manner of the signature of the treaty or protocol. And secondly, the two countries shall discuss, as soon as possible, the exclusion of such payments from the Article 12 definition in the Serbia-Singapore Treaty. This is definitely not a self-executing MFN provision. And now to the Indonesia-Singapore Treaty. Article 5.2h is the provision in the PE definition which deals with a building site or construction, installation or assembly project. It's similar to Article 5.3a in the UN Model Treaty, except that it adds this second sentence. It is understood that a time limit of 3 months shall apply to an assembly or installation project performed by a person other than the main contractor. In other words, the time threshold for persons other than the main contractor, for example, subcontractors, is reduced from 183 days to 3 months. Another point I would make concerns the placement of this provision in Article 5.2, which, as you know, is described by the OECD and UN commentaries as consisting of a series of examples of situations which might satisfy Article 5.1, but only if the tests in Article 5.1 are met. However, the 3 months time threshold makes clear that Article 5.2h is not a mere example of an Article 5.1 PE, but is instead a separate form of PE. Article 5.2i is a furnishing of services PE, which is notable for two reasons. Firstly, the time threshold has been reduced to 90 days within a 12-month period. And secondly, instead of saying through employees or other personnel, which is the phrase used in Article 5.3b of the UN model, Article 5.2i says through an employee or other person, and then qualifies that by saying other than an agent of an independent status within the meaning of Article 5.7. The switch from personnel to person is significant. Person is defined in Article 3.1 to include a company, whereas the common meaning of personnel would be limited to individuals. Therefore, Article 5.2i can apply in a situation where the services are furnished through a company other than an independent agent. Two other brief comments on Article 5.2i. Firstly, the plural employees or other personnel in Article 5.3b of the UN model has strangely become the singular an employee or other person in Article 5.2i. Secondly, the placement of this provision in Article 5.2 should not lead to a conclusion that it's merely an example to support Article 5.1. As the provision does not require there to be a specific place in the source country, this is definitely a separate form of PE. Article 10.6 allows the source country to impose an additional tax on the profits of a PE, subject to a cap of 10% of the amount of such profits after deducting income tax and other taxes on income imposed thereon by the source country. It's curious that this provision has been placed in Article 10 rather than Article 7. Note that the additional tax is not imposed on repatriation of profits by the PE. Repatriation is not required, and so there's no real similarity with dividends. And although the non-discrimination article in the treaty contains a provision on the taxation of PEs, the introductory words in Article 10.6, notwithstanding any other provisions of this agreement, make clear that Article 10.6 would prevail. But Article 10.6 is subject to Article 10.7, which says that Article 10.6 shall not affect the provisions of production sharing contracts relating to oil and gas and contracts for works for other mining sectors. This would be relevant to those contracts which set out an alternative basis for taxation of PE profits in those sectors. Article 13.4, which allows the source country to tax gains derived on the alienation of shares in a land-rich company, is similar to the corresponding provisions in the 2017 OECD and UN models. However, Article 13.4 in the Indonesia-Singapore Treaty includes 4 limitations on the source country's taxing rights. Firstly, the alienation of shares which are traded on an approved stock exchange are excluded, although Article 13.5 might apply instead. I'll discuss Article 13.5 in a moment. The treaty does not define the term approved stock exchange. Secondly, Article 13.4 applies only if the alienator owns at least 50% of the total issued shares of the company whose shares are alienated. That is a significant limitation on the source country taxing rights. Also, in applying the 50% ownership threshold, the treaty does not include a provision which requires the aggregation of interests held by associates. Thirdly, there's an exclusion for gains derived from the alienation of shares deriving value from immovable property in which the company carries on its business. And finally, there's an exclusion for gains derived from the alienation of shares alienated or exchanged in the framework of a reorganization of a company, a merger, a scission, or a similar operation. Article 13.5 applies to gains from the alienation of shares in a company which is a resident of Indonesia and traded on the Indonesia Stock Exchange. The provision allows Indonesia to levy its domestic law withholding tax on such gains. And the final provision I've selected is Article 24.5, which limits the non-discrimination article to covered taxes.